Hello, my name is Matthew Pillmore, and I'm the president of VIP Financial Education, and you've stumbled into one of the most extraordinary financial classes that you'll ever see. And you're going to be very glad that you came across this because it'll change how you look at money in banks forever, I assure you. Don't worry, I don't have anything to sell you. There's nothing to buy by the end of this training. In fact, we're going to give you a number of very special incentives for sticking around to the end. And I don't know why you wouldn't anyway, because 1,000 out of 1,000 people that I've spoken with agree that the bank's rules aren't built in favor of us. So it's not that hard to believe that there are better ways of doing things in order to get ahead a lot faster. Why walk when you could drive? Unless you just prefer the leisurely aspect of your financial progress, then utilizing vehicles to fast track getting from point A to point B is only logical. And I'm going to prove it today with the mathematics. In any economic condition, these techniques will make you significantly safer and significantly wealthier if you use them correctly. It truly is building a capital and cash flow empire by beating the banks. So this is all about beating the banks today. Now, the training objectives include a little bit about VIP. I want to teach you what you may not know about us and just spend 60 seconds on that. We're also going to obtain unlimited capital. I'm going to teach you what it's going to take to get access to some of the most popular capital accounts that you can put to use and fast track your results. We're then going to discuss 3 very simple steps to turn the banks against themselves. You can truly put 50, 60, even 75 or 80% of the interest costs that you're paying on your mortgage and non-mortgage related debts right back in your pocket without any sacrifice in lifestyle and without having to make more money. The choice is yours. Either do it or not. I have yet to come up with a reason not to. And finally, we're going to discuss how you can save over $75,000 on almost any real estate buy and hold long-term property. So to introduce you to VIP, if you're unfamiliar with our trainings, this is a very exciting class because it's an updated version of one of our most popular courses. We've been around since 2000 teaching classes like these, and we now teach tens of thousands of people every month. We've become the leading cash flow, debt, and both personal and business credit experts in the entire world. In fact, we're teaching now in over 20 countries, and we have countless reviews that you can go on and see for yourself. Google us, look up VIP Financial Education, and if you like what you see, please don't be afraid to share and even check out our referral partnership program, which is absolutely revolutionary and can change your earning potential forever. Make sure you fill out the Cash Flow Cruncher spreadsheet, which is going to be awarded to you today for free by the end of the class. I'm going to teach you where you can get a copy of that very comprehensive Excel worksheet. And once that's completed, you're also going to get access to something that we've only done a number of times, and it was an absolute feeding frenzy. You can go online at the end of this training and you can schedule a complimentary one-on-one game plan implementation coaching session. It's completely non-solicitous, and if you think about it, it's probably been some time since you've had specialists that look at the liability impact against your overall wealth development and have had an influence over your improvement of that plan. So this is a great opportunity for you. To learn a little bit more about us, go to aboutvipfinancialeducation.com. You'll learn that we've done these courses for companies of all sizes, companies like NASA at Johnson & Kennedy Space Centers through Foundation for Financial Wellness. Chicago Title is a big company that we've shared our education with for years. The most well-known real estate agencies in the country and in some cases the world, such as RE/MAX Professionals or even Coldwell Banker. And we've also taught to organizations like the police department or the most significant real estate investment associations around the country. Here's a great testimonial from the police chief, Jim May, just outside Denver, Colorado. He said, "When I first saw this, I thought, holy smokes. It was very informative and a great process. We've loved having the classes at the station, and we're really making great progress with our coach. Can't wait until the next class." From Jim May. about our reputation, we do have an A+ rating with the Better Business Bureau, which is really important to most people. Here's one last piece of feedback from Karen Myers. She said, I'm the program director that's been offering the VIP debt-free education to the employees of NASA. We've received wonderful feedback and plan to increase the availability of the curriculum. I would strongly recommend this information to anyone. It doesn't get a lot better than that, folks. Now, my experience has been that this can be hard to learn. It wasn't easy for me to learn. I came into this for the first time with years and years of financial background. So knowing firsthand how challenging it was for my brain to wrap around some parts of this, I don't expect you to be an expert by the end of the class today, which is why we're going to make it very easy for you to continue on with your education and not ask for anything in return. It is, however, easy to implement. What I love about this is that it does not demand much from me. I have a very busy schedule, as I'm sure you do also, which means things that are difficult often get backburnered. And what we want to do is make sure that you can remain disciplined to this, because without your accountability, it will not work. So your undivided attention throughout today's class is necessary. Write down your notes. Make sure you document your questions, because we're going to give you that opportunity to sit with one of us one-on-one over the phone, very conveniently, in order to determine the compatibility of this information with your specifics. So the second part of this study is completely customized. Now, what we're going to be covering today are 3 very, very simple steps to success. The first is optimizing FICO credit scores. This is not just your Fair Isaac Company personal credit scores, but also your business credit scores. By optimizing your credit, you can then leverage that credit in order to get access to what we call debt weapons. Now, debt weapons is another term for capital accounts. It's a little more fun to say, but capital accounts will help you achieve and accelerate the 3 specific areas of the most important financial aspects of your future. We're going to put those capital accounts or debt weapons to use in step 3. That's where these get safely utilized in order to eliminate liability, grow your assets, and stockpile emergency reserves. We're going to do this through 3 specific techniques today that I'm going to teach. And these are techniques to kill the banks. The first is lump sum payments. Now, lump sum payments are a way for you to turn the banks against themselves. The second technique is paycheck parking, where we can replace the inadequacy of the most commonly used bank accounts, checking and savings. Is your checking and savings account doing much for you financially? I didn't think so. We're going to show you how you can do something about it. And finally, cash flow stacking. Now, cash flow stacking is where you're able to pile money upon money upon money in order to accelerate your objectives. So let's start with step 1, optimizing credit. You probably have a personal credit score that's established now, and it may come with varying depth. Everybody has their own financial fingerprint, so you're different than the next person. These scores, however, are imperative to your success. Here are the goals you need to strive for. The target Fair Isaac Company FICO credit score is a 760 or better. However, the minimum to achieve the results that I'm going to demonstrate today is a 700 and better. Now, if you don't have a 700, I don't want you to worry, because there are personal credit scoring maximization solutions that are 3 times more effective than credit repair. And we'll discuss that together during your complimentary session. Credit is not a reason to not be practicing what we teach today. The only reason that you would not be a good candidate for today's demonstration mathematically is positive cash flow. Now, VIP defines cash flow as the difference between what we earn and what we spend. That only comes in 2 different forms, either a positive number or a negative number. We're either earning more on average than what we spend, or we're earning less on average than what we spend. In order for what we teach today to work, you have to have positive cash flow. So I want you to keep that in mind. Now, what we've done for those of you who have less than perfect credit is created the 760 Club. At the age of 23, I became a certified FICO credit scoring expert. I studied under pioneers of this industry, even a gentleman that was one of the original creators of the Fair Isaac FICO credit score, which means that we know far more than anyone really needs to about personal and business credit. So let me teach you a little bit about that today. There are two big reasons that we have to focus on credit scores. The first is it will significantly reduce your expenses, not just interest rates, but insurance premiums. Secondly, and even more importantly, is you will then have access to tons of capital. And I'm telling you that with capital, anything is possible. So let's break down the personal credit score. Fair Isaac created an algorithm that creates the FICO credit score by processing the data that's housed in the three primary credit bureaus, Equifax, TransUnion, and Experian. When they process your score, it will range from between 300 to 850. Now, there are five main components of this score. The first is payment history of 35%, and the other four elements are generally neglected, which is why credit repair falls short of driving those scores higher. In your free coaching session, we'll talk about all five components in order to bring that score up if necessary. Business credit score is something that a lot of people don't know anything about. It's based only on one factor. How have you paid your bills over the last 12 months? Now, if you've paid your bills as agreed or earlier, you'll instantly establish an excellent credit score of 80 or higher. There are three main bureaus to business credit also. The first is Experian Business, the second is D&B or Dun & Bradstreet, and the third is Equifax Business. What we're going to talk about is how we can leverage both personal and business credit scores in order to get access to these capital accounts that we call debt weapons. So what the heck are debt weapons anyway? Well, debt weapons are accounts that allow us to put our money to work nearly every day of the year. Let's talk about the 7 key benefits of these accounts. Make sure you write this down. The first is we want to maximize cash flow. Listen, I cannot stress the significance of cash flow to you enough. Some of the most successful people that we've worked with on a one-on-one basis have been the people who earned the least. And some of the people who were in the most significant financial trouble were people who earned the most. It's not about what you earn, it's about what you keep. Cash flow being the difference between what we earn and spend. Now, at some point, there has to be a transition between linear or transactional income and passive or residual income. We have to make sure that income gradually starts to come in from sources other than where we're transacting our time and effort, which is the only way to create true freedom. Almost everyone we speak with is more motivated by freedom than money, which means that we just want freedom of choice. And I'm sure you're not the exception. You probably just want to be able to choose how you spend your time. Cash flow is the magic formula for allowing you to have that freedom. It's priority number one. And that is one of the single most influential parts of a capital account. The second that I love is compressing amortization schedules. If you agree that the banks don't build their rules in favor of us, then it'd be easy for you to understand that a 30-year loan is absolutely ridiculous. So are the terms of repayment on any loan that the bank has asked for you to do it that specific way. What we're going to do is question the traditional way of doing things. We're going to show you how to pay off your debt in a fraction of the time. Next, we're going to create better bank accounts. Again, no monetary benefit to the most commonly used financial bank accounts. What we're going to do is offer convenience, liquidity, and safety through these capital accounts, which is all you're getting for your checking and savings now. But you're also going to put your money to work for you every day. Fourthly, you're going to be able to invest more quickly and safely. Whatever your investment vehicle is, you're able to do it significantly more rapidly and securely by implementing what we're going to share with you here today. Next, you're going to be able to minimize the volume of interest. This benefit I can't speak highly enough about. You don't care about the interest rates, you just think you do. And I'm going to prove to you today that it isn't interest rate that's important, it's total interest costs. And if we can take interest costs and put them back into your pocket by making very small adjustments to our behavior every month, there is no downside to doing that. The only excuse would be laziness or fear. We're going to help you overcome both of those two things. The sixth benefit of capital accounts is being able to enhance your FICO personal credit scores significantly more quickly than you would otherwise. Now, there are 16 categories of capital accounts or debt weapons, and we've converted some of them into community education to help you learn more about them, because we won't have time today to go into great detail about the specific capital accounts that are available. Now, I like to look at these capital accounts the same way as vehicles. So we drive our cars, we fly in airplanes, we ride in boats. These are ways for us to fast track how we get around. If you want to supercharge your plan financially, you have to look at capital accounts the same way, where you have absolutely no discomfort, sense of fear, or being overwhelmed about going out into your driveway and hopping in your car and driving off. And capital accounts are eventually going to have to become that comfortable for you to use as well. These are the vehicles that you will get into financially in order to achieve your goals in a fraction of the time. You can see that most of these are broken into acronyms: mortgages, personal lines of credit, business lines of credit, home equity lines of credit, secured lines of credit, certificates of deposit, business credit cards, consumer credit cards, etc. These are all mostly provided inside financial institutions, as you know. The bottom 8 categories of debt weapons are often provided outside of banking institutions. However, everything in gold has already been made into a free class for you. So you can go online easily and just watch those on demand anytime, 2, 3 a.m. in the morning, no registration necessary. So make sure you start to see all of our classes and then share those with others as well. Now, here are the details that you need to know. We've narrowed it down into some common denominators between each of us that are imperative to your ability to access and utilize capital accounts. The first is we have to answer 4 specific questions. Which capital account do we get next? Where do we go to get it? When should we apply for it? And why are we getting it in the first place? What purpose will it serve? Keep in mind, we're never ever done looking for more capital accounts. There are terrific educators that are out there for the basics, financial 101. What I'm going to show you next is not the 101 version of finance. This is for people who are already doing well, they have positive cash flow, and are looking to fast track where they end up, which means we're never done looking for more capital accounts. Educators that teach cutting up credit cards, getting rid of availability. If you're capable of being savvy, then there is no reason to limit the amount of credit that you have available to you. Don't make the mistake of confusing credit with debt. We believe debt is bad. However, we believe in leverage. So that may sound like a contradiction, but the reality is, it's not that we are afraid to borrow. We want to borrow. In fact, we'll borrow for absolutely everything we can because it can produce for us really large returns on investment by doing so. What we don't believe in are the terms of repayment. So we're always looking for more capital accounts, and we've got to answer these 4 questions before we can access our next. The second thing that you have to understand is that VIP researches these for 20 hours a week. We've got a part-time person that we have calling the banks and gathering details in order to properly teach members how they can access capital accounts of their own. The third thing that you want to understand is that with a 700 or better minimum personal FICO credit score, you can get access to between $25,000 and $250,000 every year. That has become the baseline standard over the last decade and a half of helping people get access to a collection of these accounts. There's only one disclaimer that I have to say here about getting access to more credit. If you have a history of fiscal irresponsibility, if you are incapable of managing your money in a responsible manner, then you should reduce the amount of credit that you have available to you. If you're capable, even if it requires you to be shown how and held accountable, of managing availability in a strategic way, then you have all the power to turn the banks against themselves. I want to impress you as early on in this class as I can by showing you these 3 bank killer techniques by eliminating the interest costs on a mortgage. Now, in order to do that, you have to understand that we're cheating interest rates, okay? You've got to think differently about rates than you probably have before. Now, where did you get your education about interest rates? Who told you or taught you that interest rates were as important as they are? Perhaps your parents or the banks? Who taught your parents? Their parents and the banks? Guys, the banking system isn't even the same today as it was half a dozen years ago. So how can what your parents have taught you be relevant still today? Some of us have taken it upon ourselves to be proactive, which is what you're doing here today. which I commend you for, because this is the starting point. This is the turning point that changes the game for you. Keep in mind that because the bank's rules aren't designed to benefit us, it isn't the rate that you care about. What you actually care about are the total interest costs, right? You care about the dollars and cents that you're writing in your check every month to pay for your mortgage and your non-mortgage related debts. We're going to show you how to put the majority of that back into your pocket. You're also able to eliminate your household debts entirely, which is what I want to cover with you next. So let's talk about free and clear real estate. You can see here what's called a truth in lending statement. Now, this is the truth in lending statement of Dan and Megan Albright. And when we first met them, I can tell you that they thought it was a hopeless situation. As I mentioned, most of our members come in with a lot of strength. That's the people who generally benefit the most. And the reason I've selected this exact case study is because it is, over the years, proven to be the most popular. A lot of people can relate to it. So I'm hoping that you'll see bits and pieces that make sense to you pertaining to your own specific financials. However, keep in mind that the way you're going to benefit most is by taking advantage of the free coaching session that we're going to offer you only one time at the end of this training in order to fast track your own specific roadmap, okay? So this is the truth in lending statement. This is a document that we sign at closing when we get a new mortgage. 3 years after we met Dan and Megan, they acquired their very first home. And they got with that new home a $290,000 loan. Now at 5.2%, which by the way is still a part of historic low interest rates, they're expected to pay $283,000 in interest on this home, which means that over 360 months, they're going to pay well over $500,000 for this $290,000 loan. That is absurd. Why would anybody do that? Let's talk about the better ways of doing things. Now, there are a collection of ways that we will teach in one-on-one sessions depending on personality types. However, the one I'm going to teach to you today is extremely easy to stick with, opens up a great deal of liquidity and stockpiles emergency reserves, and it's also very easy to implement. So I'm going to demonstrate this one here today. You can see here where I've transitioned their basic financial profile. We've got a $290,000 new mortgage at 5.2% and $283,000 in interest. On the right, you can see where we have collected debt weapons over the initial 3 years of their plan. They had paid off their credit card balances. They had several new accounts, including 2 new personal lines of credit, for a total of $78,500 of availability with no balances on those accounts at this time. You can see that they were still earning $5,950 take home into the household each month. That was their average. Dan was self-employed and Megan was W-2'd, so there was inconsistency with income, which is really common. That's why averages are necessary. You can see that they had also expenses to pay each month, including a new $1,600 mortgage, along with $2,325 worth of total living expenses. That included everything from utilities, cell phones, their food, gasoline, entertainment, car insurance, health insurance, pet care, cosmetics, etc., etc. Okay, so everything is included in that average. That number also fluctuates. It doesn't just fluctuate for Dan and Megan, it fluctuates for everybody. So you've got to base your spending on averages because, let's face it, your car doesn't break down every month. At least let's hope not. So the average end of the month cash flow for Dan and Megan was $2,025. Now this, after 3 years, was up from a starting point of $390 per month, which is why I'm so excited to show you this example, because obviously that's about 5 times the cash flow increase without earning any more money each month and without spending any more money each month. I bet you're wondering how that happened. So let's go through this step by step. The first thing that we're going to do here is we've got to understand real estate, okay? We have to understand that there's an amortization schedule where the banks are making the majority of the interest in the beginning of the loan. It's still a simple interest loan. You're paying interest on what you owe, but you owe so much more in the beginning that you're paying a tremendous amount of interest. What we do is we calculate what's called an MLS, or maximum lump sum. That maximum lump sum is the amount that we can safely borrow from one of these capital accounts or debt weapons and then apply it to turn the banks against themselves. So we're going to take one bank and we're going to attack the other. In this example, the total was $20,000. And I want you to know that we're going to calculate this MLS for you during that free one-on-one coaching session with one of our experts. Dan and Megan take $20,000, and you can see here that they did that from this brand new, very special type of unsecured capital account, a very specific special type of PLOC, personal line of credit. They take $20,000 of this $25,000 of availability, and you can see that when they do that and apply it towards this mortgage, the mortgage reduces from $290,000 to $270,000. Now they have a new $20,000 balance on this PLOC. So there's $5,000 still available. So now what? Well, traditionally, which we all agree is the wrong way of doing things unless you enjoy bringing the banks along as a passenger on your journey to success, we'll deposit our money into checking and savings accounts the moment we earn it. That in many cases is done automatically for us. What we're going to do now by using these capital accounts is put money to work for us almost 100% of the time, instead of allowing our money to go into a checking and savings account where it's unemployed. It's a very easy transition. We, instead of parking that money into checking and savings, paycheck park that money against the new $20,000 capital account or debt weapon. That money then sits in the account just as it would our checking and savings until we need it, at which point we pull it back out and we pay our bills. By doing so, we get several advantages. We reduce compound interest, which, by the way, it's been said that Albert Einstein considers compound interest the eighth wonder of the world. We maximize cash flow, which we all agree is the only ticket to retirement and freedom. We compress amortization schedules so that we're out of debt in a fraction of the time. Who doesn't want that? And we maximize credit scores, which constantly opens up endless capital and premium rates. This process is repeated every single month. I want to show you how it works using the mathematics, because skepticism is invalid when you can see 2 + 2 = 4. You can see $20,000 still here and $20,000 here. So here's the income that they'll earn in month one. Month one, instead of parking that income into checking and savings, they're going to paycheck park that here as a large payment, which reduces that balance to $14,050. You can see over here that the increase of availability takes place to now about $11,000. They have to now pay their expenses, which they're going to do from this availability. In this first month, they pay $23.25, which is all of their monthly costs except for the new mortgage, which they don't have another payment on because they just gave $20,000 from the capital account to that balance, which counts as part of the payment. You can see that that increases their balance to $16,375 approximately. In month number two, they just repeat the process where $5,950 is paycheck parked against the balance, dropping that down to $10,425, and then they'll pay the expenses again, which in this case includes the mortgage, making it a total of $39.25, and the end of the month balance in the second month is $14,350. Look how much they've reduced this balance in just 2 months. How quickly are you reducing your mortgage? It's pretty painfully slow, isn't it? Now, we can fast track this example because every month this cash flow position remains parked against the balance, which means I can just take this remaining balance of $14,350, divide it by the cash flow of $2,025, and it will tell me how many additional months this will take, excluding the interest. This is before we've added in the interest costs. So you see a 7.1 total month payback period on top of the first 2 months that we went through. And now let's add in the interest, which in this case, we're estimating $1,000, which is much too high, but we're going to always estimate conservatively. That's at a 10% rate. Now, this was the most confusing aspect for me when I was first introduced to this philosophy, which was how do you take higher interest rate debt weapons and use them to rapidly accelerate the elimination of lower interest rate mortgages or balances elsewhere, and in the end, save tens and generally hundreds of thousands of dollars in interest? And the answer, my friend, is something you already know. If I offered you a 10% interest tool or a 4% interest tool, which one are you going to want? Obviously the 4%. Now, what if I told you that this 4% tool was a loan paid back in 30 years, but this 10% interest tool was a loan paid back in 10 months? Which one do you want now? the 10%. So what's the other half of the equation that we seldom as consumers are taught to pay attention to? The term. The banks are happy to spread things out over 30 years. Have you noticed that? It's because it exponentially increases the total interest cost that you're going to pay. So what we're going to do is decrease or compress these. And as you can see, this is a 9.6 month total cycle. We're going to round that up to 10 months, again, just to be very conservative. All right, so let's talk about the amortization chart. Month number one, they do what? They give how much money from the capital account towards their mortgage? $20,000, right? Okay, guess what? When they do that, they hack this enormous amount of interest out of the equation. It's no longer there. They actually leapfrog down the amortization schedule by about 4.5 years. 10 months later, they've paid that capital account back and they repeat the process, leapfrogging them again and eliminating all of that interest. This process is repeated every 10 months, slicing this amortization schedule into little bitty pieces, turning the banks against themselves to where the majority of the payments are going toward principal. Let me demonstrate to you. Now, as you can see here, this is the spreadsheet that I've promised all of you will get for attending here today. I'll give you the website that you can go to towards the end of the training. You can see there are several different pages here that will help you with your finances. This spreadsheet is very easy to use and it fills out in about 30 minutes for those of you who are organized. If it takes you a lot longer than that, you either have a very complicated puzzle or you are not as organized as you need to be with your finances. We're going to help you with that. You'll actually complete this in advance of the free one-on-one coaching session that we're going to have together so that we can take a look at your numbers and help you implement a better strategy. Don't worry, we're never going to get account numbers or social security numbers from you, so your financial health is always safe. This is the loan calculator page of this cash flow cruncher, and as you can see, Dan and Megan's numbers have been plugged into this spreadsheet already. $290,000 mortgage price at 5.2% APR is a starting back in 2011, 1/1 of 2011, puts a $1,592 monthly mortgage payment. That's principal and interest. Now, I want to illustrate for you why this is so disadvantageous for us, why these amortization schedules are considered one of the most insidious devices ever created by mankind. Take a look at this. This is the interest to principal breakdown. It's almost 4-to-1, right? And over the course of that 30-year, 360-month term, Dan and Megan are going to spend $283,000 in interest on excellent rates. So what we've done is we've taken $20,000 and we have, in month number one, I'm going to do it in month number 3 here because I just want to show you the leapfrog effect. And you can see here what I was talking about earlier. We're dealing with a $1.47 increase to principal each month. The payment stays the same every month. So each month, $1.47 more is paid towards principal and $1.47 less is paid from interest. So you can see why this is just so painfully slow and why when we're making our mortgage payments, so much of it is going toward interest. What we did was we took $20,000 from one bank to turn against this bank. Watch what happens when we do. In just one move, Dan and Megan have saved $64,000 in interest costs on this house. $64,000 in one move. You can see where they've leapfrogged. Instead of $1.47 in principal increase, they've jumped all the way to $429 from $340 every month. Now, how often were we able to do this, my friends? Every 10 months, right? So let's scroll down, and we're going to put another $20,000 in there. From payment 5 here, we're going to go to payment 15 here and put another $20,000 in. Then we're going to go down to payment 25. And through paycheck parking, this $20,000 is paid back. Keep in mind that every year we're adding $25,000 to $250,000 of availability. So if it's ever needed, we have it. But we're only relying in this example on $20,000 per cycle. You can see here that after their third step, they've saved $142,000, and you can see that this was January 1st of 2013. Guys, they started in January of 2011. Okay, this is 2 years they saved $142,000. Now, is everybody going to get the same results? No, of course not. But why wouldn't you save even $10,000 if you could? During your free coaching session, I'm willing to bet that I can save you at least $50,000. Okay? So let's challenge each other and see if that's possible. Now, what happens if Dan and Megan want to continue to acquire new real estate, which they did want to, and they have since this time started acquiring new rental properties? All it does is fast track this process where they're then able to add to these lump sum amounts either in size or frequency to where this process is only expedited. It is not one or the other. You cannot simply grow assets and worry about your debts later and expect to retire. You can't simply worry about your debts and leave your asset growth for later and expect to retire. We have to be working on both at the same time. And it's very easy to do once you understand how. So let's go back to the slides here because I want to illustrate for you the end result if Dan and Megan were to follow this process to completion, which they're on pace to do now. That $283,000 of original interest that they agreed to pay the banks has now been reduced to, drum roll, $72,500, guys. $72,000 instead of $283,000, which equals $210,000 worth of interest prevented. And even more exciting to some is that they were able to avoid over 21 years of payments. This is mind-blowing. Don't make the mistake of falling victim to the bank's rules. These same techniques work with non-mortgage and business-related debts as well. In fact, we've identified 17 techniques for credit, 34 cash flow maximization strategies, 28 ways of reducing debt in an accelerated manner, and 16 total categories of debt weapons, which means that your puzzle is different than everyone else's. There are millions of combinations. So in order for us to identify the exact timeline that you can expect to achieve the results you want, we have to look at how your plan will be different from everyone else's. We have to customize it. Now, there are 4 specific things we're looking at when it comes to eliminating non-mortgage related debts. The first and most important is target rate. This is different than the interest rates. In fact, the target rate is calculated for you here on the debts page. Another very special feature of the Cash Flow Cruncher. The target rate indicates the impact to cash flow. Everything we're talking about is how you keep more money every month. It is the secret formula to success. The second thing that we're going to be looking at when we get rid of non-mortgage related debts are the types of accounts that you're dealing with. Revolving versus installment. They are treated differently and will impact both cash flow and credit scores differently. Credit scores are an incredibly important piece to what we're doing, as we've talked about already. So we're always protecting those and driving them up. The fourth and final element of eliminating your debt quickly is that of interest rates. Again, interest rates are interesting. Do they matter? Sure. Do they matter as much as the bank wants you to believe? Absolutely not. So let's talk about the summary of Dan and Megan's plan the 3 years before they acquired that new mortgage. You can see at that time they had the same income amount of $5,950 on average each month, $14,400 in total credit card debts. They had 2 auto loans, I think $20,000 and $15,000 totaling about $35,000. Their credit scores were mediocre at 668. Their average cash flow position was risky at $390. And their overall debt weapon availability, without even knowing it, was $9,750. Their overall lendability or borrowing strength was poor. In the first cycle, we were able to pay that back in 12.7 months. In the second cycle, we were able to pay that back in 10.2 months. In the third and final cycle, they paid off the last of their non-mortgage debts, which took 8 months, for a total of 30.9 months that it took Dan and Megan to pay back almost $50,000 worth of non-mortgage related debts. Now, how long would you expect it to take a family that's not able to change their behavior to pay off $50,000 of non-mortgage related debt? Probably never, right? So it required this behavior change and it required accountability. And it's still shocking to people that they were able to do it in about 3 years' time. You can see what their profile looked like just 3 short years later. They had the same income. They had no credit card debts. They had no auto loan balances. Their credit scores were through the roof. They had an average cash flow position without reducing their spending or sacrificing in lifestyle of $2,025 or $2,035 instead of $390, 5 times better. And their overall debt weapon availability had increased to $78,500. Now they're able to increase debt weapons every single year after this because their borrowing strength is so strong. All right. So the question is, what do you do next? How do you actually start and put this to practice to where you can fast track your results for you and your family? Well, let's talk about a few different bullet points that you're going to want to keep in mind for really any decision that you make moving forward. First, every household is different. So we've got to consider that this is going to be unique to you. There are many, many options that can help you implement things like this. You've got to understand the solutions that are available, and then you've got to remain consistent with them. We've reviewed countless programs over the last decade and a half. So we've done this homework for you. And what we found is that you've got everything from free education like this, books and tapes, training products of $50 to several thousand, all the way up to $50,000 coaching memberships. Guys, most of this is going to be completely unnecessary for you. Let me talk about the deal breakers, okay? Because these are going to be what stop you from succeeding with what we discussed today, mathematically. First, you've got to earn more than you spend. You've got to have a $500 average cash flow position or better before it makes sense for you to take advantage of the free coaching session that we're going to provide for you. Now, if you don't yet have an average of $500 or more, simply email. This is if you're negative cash flow. If you don't have this $500 plus average cash flow position, email help@VIP Financial Education, and we will help you get to that average $500 or better so that the most popular techniques can be implemented into your life. Until then, they're on standby. If you're capable of taking action when shown how, then you will do very, very well with this. It's just a matter of following simple instructions. Does the solution have proven results along with a positive reputation? You've got to do your homework anytime you're considering any type of solution. You need to know if it's going to push you harder and faster than you can push yourself. Look, learning new things is always faster with somebody that is experienced and knowledgeable showing you the right way of doing it. So surround yourself with a great team. Will you get a strong return on your investment? ROI is a very important component to your decision making. The next thing you have to make sure you vet when you're looking at available solutions is, will the company refuse a sale? As I just alluded to, VIP is very particular about that. Now, one thing you'll find if you do enough research is that VIP has no competition. There are people that teach bits and pieces of what we do. There are software programs that you can spend thousands of dollars to get. However, we are the most comprehensive and considered the foremost leading experts on this collection of topics, which the collection is the secret to the recipe. If you leave ingredients out of a recipe, it doesn't taste the same. Don't leave ingredients out of this recipe or you will be very, very sorely disappointed. So let's talk about selecting the right techniques. First of all, you've got to fill out this cash flow cruncher. I'm going to give that to you now. The website to get your free copy of your cash flow cruncher is cashflowcruncher.com. That's cashflowcruncher.com. Go ahead and download your free copy of that Excel spreadsheet. If you aren't currently using a copy of Excel on your computer, then you may want to look into downloading an open source, open office type of provider, because it will also download there, but maybe with limited functionality. We're then going to schedule your complimentary coaching session. We're going to use the free tools, and we're going to then review your starting point and where you want to end up. We're then going to reverse engineer which techniques are going to be best suited to your individual needs. Keep in mind that with discipline and accountability, there is no way you can fail. If you have at least $500 per month positive cash flow, this is mathematically guaranteed to benefit you. So make sure you take advantage of the next step and get on the calendar, which is going to be your only opportunity to do that. None of what you share with VIP, including inside the Cash Flow Cruncher, nor in the session itself, is going to put your financial health at risk. We won't get account numbers. It will be completely non-solicitous. We don't need social security numbers. And therefore, we're just dealing with general numbers. But we also are incredibly careful with your privacy and confidentiality. We know that this is sensitive information. So we just want to reassure you that you're safe. Next, anybody that needs credit education and enhancement, VIP will share our very unique expertise on driving personal credit scores to the area that is relevant for steps 2 and 3 to be impactful for you. Now, we are 3 times more successful at getting credit scores stronger because of a very, very unique approach to that. So we'll talk about it in your session if it's needed. This is donated free to members. Now, for those who would like to fast track, there are 2 specific memberships that you may or may not be qualified for. The first is that of a capital account empire. This is where we work with people over the course of a 12-month term in order to get them between $50,000 and $250,000 worth of new capital accounts. The best thing about this is it's one of the first ever that doesn't charge unless we get at least $50,000. So the success or results will pay for themselves. The second is the cash flow diamond coaching. This is the most popular membership that we have provided over the last decade, and it includes unlimited phone coaching to potentially anywhere in the world. Now, we traditionally stay primarily domestic in the United States. However, we do have a limited approval ratio in other parts of the world at this point, and the cost behind that is $289 a month. Now, as I previously stated, if we're not playing with the bank's money, we're not playing at all. Mathematically, you wouldn't be qualified. So this either pays for itself exponentially and is one of the single best mathematical financial investments that you would make, or you're not qualified. So it's as simple as that. You do not have to worry about being solicited to. Rebates and discounts may also apply, so make sure that that's something that we discuss during the complimentary session if you end up being a qualified candidate. Lastly, business owners will also get free marketing, meaning that marketing materials and social media supercharging is all included for that price. And furthermore, tax deductibility of this membership has never been a problem. So talk to your tax professional if you are a qualified member and you get started about writing it off and saving some of the money. Lastly, as I'd mentioned once before, we stand behind everything that we provide with a 100% satisfaction refund policy. So as long as you remain active, we will take on the entire burden of this risk. So let's just get on the phone and let's talk about it and see whether or not it's beneficial, okay? So here are your next steps. This is going to be the only chance that you might get to get a free session with me. If you register now for your free coaching session, we're going to do everything we can to rearrange my schedule, and perhaps I can be the one to help you personally. But even if I can't, you'll get a coaching liaison that's been personally trained by me. And we only consider people who are excellent in order to determine how this can work for your family, okay? Now, this is a no sales, no pressure discussion. It's completely free. There are no strings attached, and it will help you take those first steps on what you need to do. But again, until you have that $500 positive cash flow position, wait to schedule your session, okay? Free classes about debt weapons will be provided to you after you schedule your call. You'll start to learn more about those as well. And then we'll also provide you a debt weapon cheat sheet, which is the very worksheet we use to collect information to understand which are the best debt weapons for us to take advantage of, and then we share those with our members. You'll be provided that after the session. So this is the only chance. Take out your smartphone, register now. When we look back on when you watched this class, if we didn't see it come in within a 24-hour period, you may lose your chance, and it will always be subject to availability, okay? So get your free coaching session with a worldwide expert. They've all been hand-selected and trained by me personally, and you might even get a chance here today if you schedule right now to get on my direct calendar for that conversation. Just go to freecoachingcalendar.com and let's beat these banks together. Thank you very much for joining today. Make sure you share this education if you found it beneficial. Take care.
VIP gives great concepts and valuable information to improve my cash flow and credit. Thank you so much. John Beasley. I've never seen anything like this. I cannot believe this isn't taught in a school. I usually hate online classes, but this was awesome. Leslie Shook. Incredible. VIP gives fantastic info. I wish I would have learned this 20 years ago. Gilda Ramirez. VIP Enterprises. Cash flow experts.